Hey guys, this is a quick DCF I put together for Salesforce. I hope this is helpful for you as you think about how to build a DCF from scratch and the building blocks that go into it. So providing this video as a quick walkthrough through the model, and happy to field any one-off questions that you may have. Feel free to shoot those to my email. So to start, in the back, we have a section of notes from the 10K. So before you build a DCF for any business, you should read through their public filings if it's a public business. So this 10K is from the fiscal year 2020. Salesforce ends their fiscal year in January, so their 2020 10K is available, but this ends for the period ended January 31st, 2020. These are a set of links that will take you to BAMSEC. BAMSEC is a great tool to find filings and statements online for public businesses. And so clicking on a link will take you to the relevant part of the 10K where these items will be placed in the 10K. So I like to keep track of historical acquisitions, properties, full-time employees, debt tables, PPE, goodwill, debt. This is all very important. Stock and restricted stock table is going to be important for understanding your fully diluted share count. And so as we note things going forward in the rest of the model, it's good to kind of come back here to pull things for your analysis and understand where things are sourced from. The next thing you'll do is you'll pull in the historical statements. So you'll pull in the historical income statements, balance sheets, and cash flow statements. These are going to be important for calculating particular ratios and running analysis to help us project forward these three statements. At the bottom of the statements, I've also included their sources from BAMSEC so that you can easily find where this is filed online as well. That's good practice to always, for any inputs that you have to your model, including assumptions if they're backed by something in the real world, make sure that you link that back to something that can be easily found, because you want the person who's auditing your model to have a very easy time doing so. So balance sheets, income statements, great. Now with that historical data and with what we believe or a thesis that we have about Salesforce, we are going to project forward these statements. So this is a three-statement model, which means that we've created a dynamic between the three statements. The biggest check that this is working properly between income statement, balance sheet, and cash flow statement is that ultimately anything that you're projecting operationally in terms of revenues and operating margin and net margin, that you're able to have something that dynamically balances your balance sheet, right? So this is like a good safety check that what you've done mechanically so far makes sense if your balance sheet is balancing. When you're building out statements, you'll want to start with the income statement, then you'll move to the balance sheet and you'll save items that have circularity, such as debt and interest on debt for later. And from the income statement and balance sheet, you can build a cash flow statement. So that's kind of the nature of the three statements and how we project them. And when you've projected the three statements with a set of assumptions, which are here on the assumptions tab, you've built essentially an operating model. You've built what the business will look like under a certain set of assumptions, and you can tack onto this operating model either, for example, a DCF, which is what I've done here, which is an intrinsic valuation method, or you can run an LBO, which with additional assumptions about entry and exit and how much leverage we put on the business, you can get an idea for what returns you would get if you believe certain things about that transaction. And so the operating model is kind of the bread and butter of models, because it's essentially projecting forward what a business looks like, and to that you can attach a number of different types of models, whether that's the DCF or an LBO, and achieve different goals. I'll note that most places don't build a three-statement model for all of their exercises. A lot of it is like just an income statement and a cash flow stub, because that'll get you most of the way there without having to really think about every balance sheet line item. But certainly some places do care about linking in all three statements, and there's a number of times where linking in all three statements really helps you make sure that you're not really making any errors in the way that you're thinking about accounts that are accruing. So after you've projected those three statements, which comes off of this assumptions tab, and you can look through this assumptions tab to kind of get an idea of how I've chosen to project certain line items. Certainly, this is not the only correct way to do things. There are many ways you can project particular line items, and just having a reason for why you did it a certain way is an important thing. And so be reasonable and logical in how you're projecting things. And this up here is a simple case chooser with the choose function that can pull in a base, downside, and upside case. Not necessary, but if you want to run different cases, it's an easy way to run different cases with the choose function. This is a debt schedule. So this is scheduled to get an understanding. So interest is one of those things that is circular. And there's a circ switch on the cover of this model, and that's a very important concept to understand. So when you have debt on a business and debt accrues interest, paying interest ultimately means you will have less net income available and less cash for the remainder of your activities. But ultimately, the amount of interest that you have is determined by the amount of debt that you have, and cash pays down that debt. So you run into this problem of having a circularity in your model, which is something that needs to be calculated iteratively. So Excel has an option. So if you do Alt-FT, it'll take you to options. If you go to formulas, you have this option here to enable iterative calculations. So this means that it'll do 100 iterations to kind of solve a linear set of equations to get you to kind of what is the answer to something that is circular in your model. And you want to make sure that while you're working in your model, that circularity, which on the front of my model here, is turned off. This means that in my interest expense line, I'm just going to fill it in for zeros with the time being. And when I turn circ on, it'll put the proper interest rate in with iterative calcs. But you can get the common phrase that your model will ref out or break down if you have circularity running through your model that's not properly accounted for. So this is a debt schedule. You've got an opening cash balance and servicing different tiers of the debt. So Salesforce has a revolver. They've got 2023 and 2028 senior notes. They've also got a loan for one of their office facilities, and calculating the interest and the mandatory repayments on all of these loans in one schedule. Great. So the Calcs tab is to kind of detail line items, particularly on the balance sheet, that are a bit more complicated. So these are things like PPE, where you have both depreciation and capital expenditures. Salesforce capitalizes some of their software, so they're capitalizing some intangible assets. So you also want to keep a proper track of what expenses are being capitalized and how that's being amortized. Similar, something that's idiosyncratic, you definitely don't see this every day, is capitalized revenue contracts. But same concept, you're capitalizing some kind of cost and you're amortizing the asset as well. And then retained earnings, this is sort of a really fundamental link between the income statement and the balance sheet. Generally, retained earnings, the retained earnings account on the balance sheet is built from net income less any dividends paid. Salesforce does not pay a regular dividend. So essentially, it can be as simple as saying the net income that Salesforce is generating flows into the retained earnings on the balance sheet. This is a beta regression. Happy to talk about this in more detail another time, but this is essentially just how do you get to a beta with an equity specific equity that you're looking at versus the market. So here I've considered the market, the S&P 500. Salesforce has a certain return that it sees on a week-by-week basis. There are many ways you could regress a beta. You could do it daily, weekly, monthly, over a 3, 4, 5, 6-year time span. I believe this is a 5-year time span, and I've regressed it weekly, which means that I've looked at the covariance between Salesforce and the S&P 500, as in when the S&P 500 goes up, to what degree does Salesforce go up as well? This is kind of the sense of covariance. How much do they vary with each other? And you divide covariance by the variance of the market as a whole to kind of normalize that for the variance of the market. So how much does Salesforce move when the market as a whole moves, and in what direction? So if it's moving perfectly in line with the market, it would have a beta of 1. It looks like, so when you do covariance of Salesforce and the S&P over the variance of the S&P, you get beta of 1.1, which means that Salesforce is moving slightly beyond, but trending in the same direction as the S&P. So that generally makes sense. And capitalization exercises are getting you familiar with the capital structure of the business. This is the tab on which we calculate WACC. I'm not going to go through all the details, but what's important here is, and you'll find this at the end on the 10K notes section, the dilutive securities. Those are several tranches of stock options as well as restricted stock units. So you have the basic share count that's on the front of a 10K or 10Q. You want to make sure that you have all the dilutive securities in that valuation as well. And so some of these to get to fully diluted share count, and this helps us get an understanding of market cap along with the face value of debt gets us to a total capitalization. We use the ratio of debt and equity financing along with the cost of equity and cost of debt to get us to a weighted average cost of capital, which is something the model is going to be very sensitive to. This is what you're discounting your cash flows by. And so this is the DCF. This is where kind of the magic happens to pull it all together and get you to an intrinsic valuation for the business. Operating profit, adding back non-cash expenses, which in this case are depreciation, amortization of capitalized software and of revenue contracts, taking out cash expenses that aren't reflected on the income statement. So these are capital expenditures in PPE, in intangibles like software, or revenue contract expenses, which is again something you do not see in most models. It's capitalizing revenue contract expenses, but it's something that Salesforce does do that you don't see in every business. Operating assets and operating liabilities are accounts that help us get to net operating working capital. This is a measure of how much cash is tied up in the operating accounts of your business. So if, for example, maybe you did a ton of revenue this year and a lot of that flew through on margin to net income, but if a lot of that revenue is sitting in accounts receivable and hasn't been brought into the business as cash yet, that ultimately means that it's not cash available in your free cash flow statement. So you want to make sure that this is reflected in your net operating working capital. And so with that, we get to free cash flow. So everybody should probably know the formula that free cash flow is roughly operating profit, removing taxes, adding back non-cash expenses, taking out cash expenses not reflected in the income statement, and taking out the change in net operating working capital. So if your operating assets go up, then that means that your net operating working capital goes up, which means that it should be removed. More cash should be removed from your free cash flow. Okay, so this has been discounted by WACC. You've got a terminal value also discounted by WACC. I won't show you valuation in this video because I kind of want to incentivize you to open up the model, but I do want to give a full disclaimer here that this is not in any shape or form advice that I'm giving of Salesforce. This is a purely educational model for you to understand the building blocks of the DCF and an example of one that is built from scratch and the thinking that goes into it and where to find that information online. Everything in this model is purely educational, and on the assumptions page, I've plugged in all kinds of things that certainly aren't necessarily reflective of my views on Salesforce. So you have to remember garbage in, garbage out for your models, and so hopefully this is helpful, and feel free to email me with any questions.